Hello traders, welcome to my channel, and in today's video we're going to look at the correct way to catch big market moves. And to do that you have to understand the concept of mitigation. So what is mitigation? Before I explain that, let's look at the theory, what it means. Let's assume price doing something like this, and then all of a sudden the market moves aggressively. Okay, mitigation simply means the closing of losing trade. Mitigation is the process of closing out losing trades. Okay, the process of closing out losing trades, or a process of rebalancing price. I'll explain that. Mitigation is a process of closing out losing trades, okay, or a process of what? Rebalancing price. I will explain both. Okay, now let's assume the big banks wants to take this price higher. Okay, so what they're going to do, they will manipulate prices in this region. Yeah, and how do they do that? They will sell the price. They will sell the price here. They will sell the price from here. They're going to sell to take out or to get liquidity. Remember, liquidity is the game. To get enough liquidity to fill up their buy position, which they will now enter from here. Now the buy position will come in from here. Okay, upward. They're going to buy. Okay, let me change this to red to show. Nope. Okay, let me change this to red. Okay, they are going to manipulate the price there. They will open a sell position here. Okay, when they open the sell position to manipulate early buyers here, because what are they looking for? They want to buy at a good price. Okay, they put the price down and then execute the buy order to move price up. Now the problem is that price moves so fast that they did not have enough time to close their their sell position. And right now, as the price move up, the sell position is in negative. Okay, they are losing in their sell trade, but they are making much money in their buy trade. So what they are going to do is to simply bring back the price by closing some of the winnings here, because they move with they execute huge amount of money, and that will show in the price. So the price will come back in here to close these sales here, and as a result you will see a lot of rejection in this area. Okay, all those rejections are simply smart money closing their sell position. Okay, they are simply closing their sell position. That is simply mitigation. When price come back into this region, we call that mitigation in forex trading. Mitigation. To mitigate simply means to close out losing trades. Okay, their sell position here will come back to be closed. Another way is to rebalance price, because when price moved there, it created area of inefficiency. Okay, it created area of inefficiency. Let me quickly use the chart here to explain the second one. If we look at here, we have efficient pricing here. Okay, all this efficient pricing, but the moment price moved below, we have inefficiency created. Okay, the inefficiency, you can see it. Just look at the 3 candles, the first and the last candle. If the wick does not touch each other, that means inefficiency has been created. So in most cases, when price comes back into this region here, it's coming back to to mitigate. Okay, it's coming back to mitigate the position, okay, to reprice or rebalancing of price. So that's what mitigation is. Okay, now how do you trade? Remember, we are anticipating catching big moves. Okay, this is what we do. We wait for price to come in here as smart money trader. Then at this region, this is where we will be looking at executing the market, because we know that price will come somewhere, okay, back to this zone. We wait patiently so that we can now move alongside smart money to catch a very big move in the market. Okay, now there are 4 places where you can get mitigation, where you'll be expecting mitigation. The first one is at area of accumulation. Area of accumulation. The second one is area of distribution. The next one is area of reaccumulation. And the last one is redistribution. Reaccumulation and redistribution. I will explain. Stay with me, please. Now, let me remove this. Now, accumulation is simply the manipulation of the lows. Let's assume you have a price coming like this, downtrend, then start consolidating. Whenever you see consolidation, you should know that smart money is trying to manipulate that area. Okay, so now the consolidation of prices after a bearish move is the accumulation phase. Okay, and what is the purpose of this accumulation? It's simply to manipulate these lows. Okay, if you enter here, you'll be stopped out. You enter here, you'll be stopped out. All these lows should be manipulated. Okay, and how do they do that? How do they now finally manipulate all this? Is by creating a sell order here. By creating a sell order to take out everybody that have been in the market previously before now buying. Okay, then that's where price move up. Another way is area of distribution. Area of distribution. After a bullish move, okay, after a bullish move, and you see price consolidating, just bear in mind that the smart money wants to manipulate the prices. Okay, the highs here. Anybody that is shorting too early will be taken out. Okay, with this distribution, they will distribute price here by taking out early sellers. And how do they do that? By initiating a buy order. In this case they will execute a buy order, yeah, to take out everyone here before the sell comes in. Okay, now as smart money trader, we position ourselves for price to come back to mitigate. Price will come back and mitigate. Okay, then we take our trade alongside the banks. In that way, we'll catch a big move. Same thing here. I will soon go to the chart. Bear with me. We have to understand the theory, the concept first, so that when you see it on the chart, you will understand it better. Okay, then the next one, the other two, is simply reaccumulation and redistribution. Now let's assume this market moves. Okay, the market moves yeah, and then starts to what? Reaccumulate again. Okay, it's simply an accumulation bet in the original direction. In a bullish trend, market stops, reaccumulate, and then push higher again. In that same case, you know that manipulation has taken place, and smart money needs to come back to mitigate this region here, because they did that by what? Selling before buying. So let's go to the chart and see what you are looking at here. Now in this case, we can see this area here that I've placed on the chart. This is the area where price was what? Manipulated. Smart money sold. The smart money bought to sell this price. Okay, and as a result, price needs to come back in here to mitigate this order here, to close the losing trade, because their buy order is in a red, and they have to come back in here to what? To mitigate. So as a smart money trader, you anticipate to take a short position from here. I'm not going to go into the details of execution, entry, and the rest because of time. I want this video to be precise and not straight to the point. Just look at the price. So you can see that price went up into this area to mitigate, to close out those positions before now moving down. So looking at that, if you have entered there, you will have caught this massive move, probably exit at this last low here, okay, and leave some position running. You will have caught a massive big move, and that is how to catch massive big move. Looking at the other side, the flip side, in this case, you can see that smart money manipulated this place, okay, by selling. In fact, the whole manipulation started here by selling, okay, to buy, and in that process they created what? Inefficiency in the marketplace. Okay, they created inefficiency, so price moved up. As price approaches here, you anticipate that they are coming in to close this position, this negative position, the sell that was in red. Then once they close that position, they can accumulate new orders and then push price high. So as a smart money trader, you can anticipate and try to get in from here, and your entry should always be in the lower time frame. Your entry should always be in the lower time frame. So what you need to do is you go to a lower time frame and wait for a break of structure in your lower time. As price is coming into this region, you wait for a break of structure in the lower time frame. When price comes in to your point of interest, then you take your trade up. By so doing, you are going to catch massive move in the market. So if you have any question, feel free to put in the comment box below. Also, I have a free Telegram channel where I share my trade ideas, and if you are interested to join, the link is in the description. Also, if you are still here and you've not yet subscribed to my channel, make sure you please hit that subscribe button, smash the notification icon, turn it from red to gray, and like this video so that when I release new video, you'll be the first to be notified. The next video is of importance to you. Make sure you watch it. Have a lovely day.